Retracements, relative strength, and relative weakness. Before we get on to how we use these concepts, let's talk about how others use them. Retracements, as far as Fibonacci retracement type levels, it's just another attempt at the Holy Grail type of analysis. They look to predict where support and resistance levels are. As we've covered, you just need to look to the left to see what's there. And a lot of these individuals that use this type of analysis, they base their decisions. Now, enough of them using it together, it can become a self-fulfilling prophecy, but only when enough of them are using it and looking at those areas. It's not that they really can predict support and resistance. The concept is actually ridiculous when you think about connecting two dots and then it puts lines on your chart, and somehow, some way, mysteriously, it's going to find where the support and resistance is. Now, if you were looking at, say, a currency or possibly a futures contract, yes, it can become a self-fulfilling prophecy, and you might want to know where the 38.2 retracement is or the 61.8 and so on. So these levels occur typically in alignment with support and resistance. If you study this over time, or even if you go and spend the next half an hour drawing retracement levels on different stocks or different indices, you'll find that the majority of times if a turning point happens at one of these areas, it's in alignment with support, because it's support and resistance that's really what matters. Now, the distance between these areas, support, resistance, supply, demand, they determine where the potential level of retracement is going to be, not these lines. So we want to keep the analysis of support and resistance based on those price areas, not the projections of an analysis tool. We use common sense. Over the years, as I did study things like Fibonacci retracements and Elliott wave and time cycles and go even deeper than that, I eventually came to the realization that these things were too subjective, didn't really follow through. They really could not predict. And what I needed to know was right on the chart. So we use retracement analysis in an objective way, and we measure strength and weakness of a move counter to the prevailing move or against the trend. So these retracement levels, they're between the most recent highs and lows, and that retracement is going to suggest the continuation or possibly the failure of a move. So in an uptrend, a retracement to major support, the low prior to a higher high, push the trend in question. It's really common sense when you think about it, because the depth of that retracement is too deep in a strong trend. Now, yes, buyers will show up there, and they could create enough demand to exceed the prior high. Again, we want to objectively look at what's happening. So a retracement that deep, all the way back down to where the move started, suggests in the moment some weakness. The strongest trends, they don't retrace that far. They pull back either to minor support or they create new support by going sideways. What we're going to do is compare retracements between various tradable instruments or the lack thereof. And it's going to give us a measure of relative strength or weakness. We'll use moving averages to help us do that. We want to keep it simple. That's what master traders do, and they use common sense. So here we have some various retracements between different levels. And what we're looking at is, and I've just drawn a stick figures here of prices moving up. And so we say the deeper the retracement to the swing low, it's in an uptrend, that's major support, the greater odds of a trend reversal. Retracements greater than 100% typically result in a short-term reversal soon after. We'll show you an example of that. So here we have a stock or market, currency, whatever it might be, is in an uptrend and it's moving up and takes out the prior high. So here's a greater than 100% retracement concept, and then a deep retracement under major support, which suggests weakness. This actually broke down through it, didn't just stop there. So the deeper the retracement to the swing high, right, in a downtrend, the greater the odds of a trend reversal. Common sense. retracements greater than 100% typically result in a short-term reversal soon after. So we use that just as an observation, this greater than 100% retracement, depending on how it actually sets up. It can provide us with short-term swings, trades, if it's climactic, or we can even use it as a part of a system for intraday trading. So here we have an example of the NASDAQ 100 and the S&P 500 with our two moving averages shown on the NASDAQ, the 20 and the 50. Over here you can see the 20, the 50, and the 200 on the S&P. Now let's think about a little bit about what this actually is showing us. Well, it does show us relative strength or weakness by making comparisons here. Now take note, where's the 200 over here? You don't even see it. The reason for that is that the NASDAQ 100 had been stronger than the S&P 500, so the 200 period moving average was well below, and that's why you couldn't see it as we're looking at the same periods of time comparing the two. And we're also going to compare higher highs and higher lows and see the distance between them and how they're moving. Now, as prices move down here in the NASDAQ 100, notice that they push down well below the 50 MA, whereas the S&P stopped right about there. And so look to the left, there is some support there, but it begins to retest here and create some new support. Whereas the NASDAQ 100 turned around and did move higher. However, at the time, it did show relative weakness. We're going to compare prices, how far they are from the moving averages and the moving averages from each other. We'll also compare slopes and location of those moving averages. So we see that both of them, look at right here, the NASDAQ was actually, you can see this is the point where it was showing relative strength. Look at the angle of the moving averages here and the distance between them versus the angle of the moving averages in the S&P 500. And there is no distance between them. They actually start to turn up at this point. And here, notice the push under the 20 and the 50, whereas this move over here just pushed down under the 20. So these moving averages are great visual aids. Their purpose, as we talked about, was to speed up the analysis. And as we look at the price action, we can see that relative strength and weakness, but just looking at these pictures provides us that analysis very quickly, and then we can look at the details of what's happening. Here's the greater than 100 retracement concept, and this is from an extended run. That's how we want to use this information. Over here on the one on the left, we see that prices had moved all the way down under the prior low. Notice the bearish wide range bar here signaling exhaustion, and then it begins to stabilize here. Now, by no means would I have anticipated, nor should you, that this is going to be the result after a breakdown like this. This is actually a bit unusual. That being said, this type of situation is one in which we could see this type of exhaustion, a little bit of stabilization here, the green bar, and put it on our interest list for the next day for intraday trading. And as it moved up, as long as our intraday time frame was moving up into this void, and notice there's nothing across that 50 MA to the left there. That's what makes it subjective as a reference point. There was nothing there, and prices continued to move up into that void. And as I said, a bit of an unusual move after a breakdown like that, but it is what it is, as I like to say. The one on the right here was the greater than 100% retracement. And it did what it should do on a pullback within an uptrend. It failed, and this isn't to suggest that you would know that it failed, but it had. What you want to take away from this is once it retraces more than 100%, and then you get this reversal candle here, well, you would be anticipating that the reversal would be coming. But once it happens, if you were long from here, well, now you have to make a decision as to take in partial profits or how you're going to manage it. On a break like this, obviously you would have been stopped out and hopefully gone before it's sliced through in this way. Now, once it retraces all the way back down again under the prior low, again, you begin to look for that counter trend move. Let's move on to retracements and relative strength and weakness, part number 2. Retracements, relative strength and weakness, part 2. And so we covered the foundational basics about retracements and relative strength and weakness. So let's see how we can apply this in different ways. But what we're looking at here is a minder that's sorted by percent change. Now, it'll show us in the moment what's outperforming and what's underperforming, but as it says, it may or may not always be where the best sector is or where we want to focus our attention. So we have to check the chart patterns to see what they look like and then see how that relates to this minder that's showing what's outperforming and what's underperforming at the time. Well, here looking at the energy sector that was at the top of the list there, up 1.22%. You see, it was outperforming, obviously. It was moving up, whereas gold stocks were moving down. And if we are focused on this as an intraday trader, well, sure, we're going to want to look at this and then look for patterns intraday that suggest that this can continue to move higher, or stocks within the sector. At that point, once it gets up to this resistance area, well, the odds increase dramatically that it's going to stall. Whereas gold stocks had been in an uptrend, moving up, out of this base and pulling back to a point where maybe here it could be at the 20 MA, or it could be further down over here at the support level where it begins to turn. So yes, this is pointing out to what is outperforming in the moment, but it's not necessarily what's going to continue to outperform in the coming days. Let's look at a index, broader market index within the market, in this case the transportation sector, and let's look at 2 stocks that are actually inside of the index. It says we're making comparisons here to tell relative strength and weakness. So the transports had moved up from this consolidation here and suggested that they could continue to move up toward this area of resistance. Now, as we look at stocks within this index, we see United Airlines has been in a downtrend and coming up to resistance. So while the transports should be able to continue higher, odds are that UAL would not, because it's rebounded up into this resistance and the declining 20-period moving average that's in alignment with it. Whereas UPS has been in an uptrend, actually outperforming, showing relative strength to even the transports, and one of the stocks that is pushing the transports higher. So this being up several days in a row, we'd look for a little consolidation, maybe a pullback into minor support. We'd look to the left, of course, to see that there is still a void until reaching some resistance, but our bias would be, because the transports look like they can go higher, UPS showing relative strength, this would be a stock that we would want to buy on pullbacks. Or if you're an intraday trader, use this one as a focal stock to trade intraday as it was moving higher. Now let's look at 2 stocks that are in not only the same index, but also similar companies. UAL, as we covered, was declining, showing relative weakness and into resistance, where American Airlines had shown relative strength to United Airlines. However, it showed relative weakness to the transportation index. So do we really want to consider trading American Airlines? I would say no. Down here, I would say yes, as a retest and reversal here at the time when the transports were actually starting to move up as well. This could have been a consideration. However, UPS would have been a much better selection at the time, since it was showing relative strength and was trending up. Now, let's look at the same concepts here, relative strength and weakness and retracements, as it relates to gaps in the morning. So as we look at the gap list, that also is a starting point. When we look at that and say, well, JWN here was gapping up almost 6%. And we're going to cover gaps in great detail when we get to that section. We'll look at where it's gapping from and to, and where it is in relation to support and resistance. FDC was also gapping up. Here it was gapping up 3%. It was gapping up into the area of this prior high. Now, we can see in 2020 hindsight that it did decline. There were other things that we have to look at, and we'll cover in the gap section as to why this may have happened. On the other hand, we see GPS actually gap down, showing relative weakness at the open. However, it was in a nice uptrend. Notice the consolidation. I'll point out to you the flat moving averages. Again, points to the consolidation. Look at the break to the downside. Look at the volume, the bottoming tail bar. We're going to cover this in another section, but this is a downside shakeout, actually bullish, and then bullish consolidation at resistance, and then prices gets above it. Wide range bar, volume, so an igniting bar, and then this little sideways consolidation creates a little area of support. Note the bottoming tail bar, and prices continue higher from there. So although GPS was gapping down on that morning, it's actually a gap down that we would want to consider buying because of what preceded it. So here's general guidelines here. A stock that remains stronger bases when an index or sector falls shows relative strength. The opposite of that is true. If it cannot rally with its sector, it shows relative weakness and is likely to fall on the next market sell-off. So here's a concept where you have a market that had been going up, the stock was going sideways, could not rally, and then as the market reaches a peak, possibly some resistance, or could even be a climactic run and starts to roll over, well, that weakness in the market is likely to now drag that stock down. That couldn't rally with it. So as the market, if it should gap down and rally, if the markets, and here I'm using the spiders and the Qs, that's what most would use. Some might be looking at the futures pre-market and then what happens at the open. But spiders and Qs will work just fine. Let's say they gap down in the morning, and then from the gap down, they rally to fill their gaps. Well, stocks that do not rally to fill their gaps, again, we're assuming that they gap down as well with the market, and they didn't fill the gap as the broader market did, it shows relative weakness. Let's say the market gaps up and then declines to fill its gap. That's going to be a focal point where buyers are going to show up. Well, stocks that don't fill their gap, again, we're assuming that they gapped up with the market, but they didn't pull back to fill their gap, they showed relative strength. Simply, relative strength suggests continued outperformance, and weakness suggests underperformance. Take note of the trend, support, resistance, distance, slope, and position of your moving averages and prices to them. As always, we're going to keep it simple. So here is an example of the S&P 500 actually gapping up in the morning and a stock that was gapping down. After the gap up in the morning, we can see the spiders did here. They chopped around for about a half hour or so, and then they broke out above that consolidation. Take note of the big red bar that didn't follow through, the big green bar pushing back up again, and this is here creating some area of support, and then it breaks out, wide range bar up. Note the volume. Same concepts intraday as daily. Everything is applicable in the same different time frames. And then this little pullback type of consolidation with the bottoming tails. Great intraday setup right here. However, the stock fell, it gapped down and fell and continued to fall. And once the market really started to rally in strength, the best it could do was go sideways. And this suggests that it's going to continue to move down. So I've put some Fibonacci lines on here. I actually, didn't put them exactly as your trading platform would, meaning 38.2, 50, and 61.8. And just 40, 50, 60. Again, keeping it simple and it's close enough. But these retracements here, while prices stalled there, it really just stalled right at this resistance area. In this retracement analysis, we use it to objectively recognize relative strength and weakness, not an attempt to locate support and resistance. You just look to the left, it's right there. So, as we look at these multiple time frames, and we're looking at the same stock here in multiple time frames, when we get to that section, we're going to go through a lot of this. But here, the further prices retrace into a prior swing, in this case, here's a high and here's a low. The further prices retrace, the more potent the reversal. It's common sense. So here, when we're looking at this, the deeper the retracement, it has to look like a bottoming tail or a potent reversal in a higher time frame. Here's the daily, and here's the depth of retracement, and here it is on the weekly. Here's the reversal and the rally coming up into this area, and here's the monthly time frame. Red candle, one red candle down, and here it is on the daily, and then the rally back up again. So as we look at these type of deep retracements, it should create the thought, well, the depth of retracement was bullish. Let me look at a higher time frame. And by looking at that higher time frame, we're looking at the bigger picture, and we're taking note of where is this happening? Is it happening in an area of support? What is above this area? We have to put the other pieces of our analysis together. Then as it comes up into this resistance area, the expectation would be for it to stall there. If it got above it, greater than 100% retracement, we would anticipate a pullback. Now, looking at the weekly, of course, we would not be a buyer because it already has rallied up to the prior high. The monthly looks like it's just getting started. So as it moves above here, again, I'm assuming that it does based on the pattern, we then would move down to the daily time frame looking for bullish consolidations or pullbacks, any type of bullish pattern in alignment with this big picture analysis. Here's a review of what we covered in retracements and relative strength and weakness. Those retracements, I've said, are used to objectively recognize strength or weakness. We don't need it to use it to locate support and resistance. Those areas are right in our chart to look at. We just need to look to the left to see them. So that makes this subjective analysis tool completely unnecessary. Common sense tells us that the deeper the retracement, the more potent it's going to be. And of course, the more potent it's going to look on a higher time frame, meaning a 100% retracement from a prior high to a prior low is going to be a bearish candle on a higher time frame, and a deep retracement from a low to a high is going to be a bullish candle in a higher time frame. More than 100% retracements after a long run has high odds of reversing. Knowing that when we see this type of deep retracement from a low all the way up to and above a prior high, we're anticipating that this is where a short-term reversal will occur. Relative strength and weakness is a very simple concept. All we're doing is comparing retracements between two tradable instruments, whether that is between two stocks, between an index and a stock within it, or a sector against another sector, or stocks within that particular sector. This is how master traders use these concepts.